just because an ETF is brand new to the market, this is for the audience, don't assume it's brand new to the firm.
All right, joining me will be Michael Cohick, Director of Product Management at VanEck, who, of course, is a top 10 ETF issuer, currently 74 ETFs, over $150 billion in assets. And last year, they began rolling out what they call TruSector ETFs. And the basic idea here is that traditional sector ETFs can't fully allocate to some of the largest companies because of regulatory diversification limits imposed on funds. So in other words, funds are capped in how much of any one stock they can hold. And so if you think about this, that's become a much bigger issue over the past several years as some pretty prominent companies have grown in size. Like think of some of the largest mega cap tech companies and how big they've become. And so if you were invested in a traditional tech sector ETFs, you'd actually be underweight some of those companies relative to the benchmark index because those ETFs simply can't hold enough of each stock. And you actually be over allocated to some of the smaller companies. But VanEck has come up with a solution to this problem through these TruSector ETFs, such as the VanEck Technology TruSector ETF, ticker TRUT. And Michael is going to explain for us exactly how they're doing that and why VanEck believes this is important. And then we'll also spend a few minutes just talking about sector investing in general. So I'll start there, and then later I'll be joined by Matt Camuso, head of ETF Solutions at Baron Capital, who back in December, Baron entered the ETF space with a launch of 5 actively managed ETFs. They're already nearing $600 million in assets. And this is a neat story because Baron has a long-established track record in growth equity investing. They've been around for about 45 years. And their new flagship ETF, which is the Baron First Principles ETF, ticker RONB, this actually holds a position in SpaceX, which has, of course, garnered a lot of attention. So we'll talk about that ETF. We'll talk about Baron's ETF entrance. And I think we'll get a really good look at how Baron thinks about growth investing. Should be a great conversation. As always, questions or comments, you can find me on X at Nate Geraci, or you can go to etfprime.com. So let me now welcome in Michael Cohick, Director of Product Management at VanEck. Michael is joining me from New York. Michael, welcome to the podcast. Great to connect.
Thanks, Nate. It's great to be here today.
Okay, so you heard I just gave some background on the TruSector ETFs there at the top. There are now 3 of these in all. These cover technology, consumer discretionary, and then just a couple of weeks ago, another one rolled out that covers communication services. And I thought, let's start bigger picture here. I'd love to have you talk more about the problem VanEck is attempting to solve for with these.
Yeah, so as you can imagine, sector ETFs have been around forever, right? So we never in a million years would have thought that there would be blank space for us to come into the sector game, the sector investing game. But, given the way the market has moved and matured over the last several years, particularly like you said, in technology is a great example. These large companies in these sectors have just grown in market capitalization exponentially. And what we've found is based on regulatory rules and diversification limits, traditional ETFs that are in the marketplace, passive ETFs or active ETFs, they're not solving for the problem where investors are not getting the full market cap exposure that they might be expecting to get in any given sector. So we saw an opportunity to come up with a solution that we believe helps investors tackle that problem directly.
And with those regulatory diversification limits, can you explain those in more detail? I just want to make sure everybody fully understands those.
Sure, yeah. So it's RIC diversification rules. So every ETF, most ETFs in the United States are registered investment companies, RICs. And they either whether they're actively managed or passively managed. If they're passively managed, then these rules are built into their index. If they're actively managed, then the manager just has to pay attention to them. But they're what we call simply the 5-25-50 rule. So no individual stock holding or bond holding, for that matter, that is a 5% weight in aggregate. Those positions can't be over 50% of the portfolio or index, and no single position can be greater than 25%. So what traditional indexes do with ETFs that are in the marketplace now, they'll create caps where they won't allow individual stocks to exceed or break those rules. But like I said earlier, with the growth of the large companies like NVIDIA and Apple, their market cap has far exceeded that. So if you look down into like a tech index, for example, they're capping the largest weights down, and then that's being pushed, like you said, at the top of the segment down to the lower weights. So you're ending up with underexposure at the large end of the capitalization range and overweight on the lower capitalization range.
Okay, and so if we look under the hood of the TruSector ETFs, what will we find? In other words, how are you getting around these diversification requirements?
So diversification is very important, and we believe in that. And if you're looking at a large benchmark like the S&P 500 or the Russell 2000, these risk diversification rules don't really come into play. They're not going to affect you. But when you start breaking apart these indexes to their smaller components, their GIC sectors, for example, that's when this problem is starting to present itself. And so we've created products that are actively managed, offering full market cap exposure to the sector they're intended to track. And we're doing this by holding individual stock names up to the RIC diversification rules. And then we're rounding out our exposure by holding another sector ETF in the specific sector we're looking at. So if for example, our technology ETF TruT, it holds a position in XLK, the spiders sector ETF.
Okay, and so just to make this clear, I think this is obvious, but I always like to cover the basics. So in that technology TruSector ETF, you do currently hold nearly 45% in XLK. And so I think that would imply the ETFs themselves are not subject to the diversification requirements as an individual holding. Is that correct?
That is correct. Obviously, there's rules around that we have to follow. Our ETF can't own more than 20% of the net assets of a non-VanEck ETF. And so with a fund like XLK, that fund is absolutely huge, right? Very liquid. So for us to break that threshold would be nearly impossible. It'd be a great problem for VanEck to have. But then we have a lot of other sector ETFs in tech that we could choose from if we wanted to. So we wouldn't have to just own XLK. We could own any other provider's ETF in combination with XLK.
And so this actually gets a little bit into a topic I'm always curious about. I can't help myself, just ETF due diligence. And I think you were alluding to some of what goes into how you select which ETFs are going to be used within the TruSector ETFs themselves. Clearly, the size of that ETF is a big consideration. Are there other considerations you look at?
Yeah, of course. Like I said, liquidity is very important. We want them to trade. Also, I think there's a bias based on client feedback that we've had that we prefer an ETF, a passive ETF that tracks the S&P 500 sector. That seems to be the benchmark that most asset allocators use most commonly versus other options that are out there. And so we have a preference for the largest or one of the largest, most liquid, and a bias towards an S&P index that as the underlying.
And I mentioned there are currently 3 of these TruSector ETFs on the market. This may be obvious, but why start with the 3 sectors that I mentioned, tech, consumer discretionary, and communication services? Is it because these sectors are the most distorted in terms of being dominated by the larger companies?
Yeah, that's exactly right, Nate. So we will look where the problem is most pronounced, and also start with the largest opportunity set. So trying to start around the pie, if you will, of the sectors of the large cap universe, tech being the largest, and then going down around the wheel. Also, like I said, solving for the problem that exists, but that's not going to preclude us from trying to offer all of the sectors eventually. We have effective filings for all 11 GIC sectors, and with intentions eventually to bring them all to market when conditions are appropriate.
And to give people an idea, if we look at, say, the actual technology sector compared to the traditional sector ETFs that are out there, how much distortion are we talking about? Like, I'm trying to give people a sense. You have this TruSector technology ETF. We can look at traditional tech sector ETFs. How much difference is there here in terms of the type of exposure?
Yeah, it's a really good question. So tech is the most extreme. So if we just look at the top 3 names, those are all over 5% weights in an uncapped index based on their market capitalization. And those 3 names account for 60% of the overall weight of that sector. And that really comes into play when you start looking at what you're getting if you own a capped ETF, and you think that you're getting full market cap exposure to these mega cap stock names like NVIDIA and Apple and Microsoft. So, for example, just looking at the top holding in technology, uncapped based on market capitalization, that should be 22.5% weight. But if you look at a capped index that's following RIC diversification rules, your exposure would be just under 15%. So that's like over a 7.5% difference in weight. Apple, same thing. So an uncapped index would be almost 20% in Apple, but the capped version would offer you 13.2% weight in Apple. So that's just under 7% underweight that holding.
You mentioned earlier that VanEck obviously appreciates diversification, which I don't think is any surprise, but I'm going to try to play a little bit of devil's advocate here, which I've been known to do from time to time on this podcast. And the question that I'll ask you is, what about investors who might say, well, the regulatory diversification requirements that we talked about earlier, guess what? Those actually force diversification. And diversification is better for investors, with a point, being that maybe that is a better way to go. And so I don't know, is there data that backs up taking a TruSector approach, or just like, how do you think about that?
Yes. So we believe that these ETFs, the TruSector ETFs, they belong in a well-diversified, well-constructed portfolio. They should not be an individual holding. So we look at diversification across an entire portfolio, not necessarily just looking at the technology sector or the communication sector or the consumer discretionary sector. These are tools for investors to express a view. If they're looking to overweight tech and be fully invested in what the technology sector looks like, these would be tools that would allow investors to do that. It should absolutely not be an individual, just single holding in a portfolio. We value diversification just like every investor should.
And if we put aside, the individual holding versus being part of a diversified portfolio, I'm curious how you view allocating to sector ETFs in general, in the sense of, are these tactical plays? Do they help round out longer term portfolio exposure? How do you think investors and advisors might think about allocating to sector ETFs? Because I think there's some debate here, right? Should I take a tactical play, or does it depend on the type of investor? Just how do you think about that?
Well, we find that these ETFs really work for, like I said, asset allocators. We have a client who uses these, that they run SMA model portfolios where they're constantly doing tax loss harvesting. So they don't just use TruSector ETFs, they use a lot of providers, and they're constantly harvesting losses for their investors. And this tool allows them full market cap exposure, which they've not been able to get in the most recent years, the last 3 years in particular. So we really think that the TruSector ETFs allow investors to express their own views. So if they're looking for tech, they're looking for AI infrastructure, semiconductors, and enterprise software. If your fund mutes your weight in NVIDIA by 7 points, then that kind of undermines that precision of that view, right? So tech and communications have a 0.7% correlation, shared macro drivers, AI spending, digital platforms. So it's really a balanced approach of what the investment objective is, we believe. And they have, I think, a lot of different applications. Again, not a single stock holding, not a single ETF holding in your portfolio, but a way to express a view. Over the last several years, you've received underperformance by investing in capped sector ETFs. And that can go either way. But a lot of times these true asset allocators, they aren't trying to beat the market. They're trying to offer the market. So if you're underweight systematically the top holdings and you're overweight the smaller holdings, then if your benchmark is, for example, the S&P, uncapped technology benchmark, you're not really offering investors what you've set out to offer. If you're an asset allocator, asset manager, an RIA, so
it's really interesting just because I do think a lot of investors and advisors, when they look at traditional tech sector ETFs, they assume they're getting the full tech sector or any other sector out there. I'm not sure that a lot of people are aware of this. So I think it's a really interesting solution that VanEck has come up with. You mentioned earlier, it sounds like the plan would be to expand this lineup moving forward. You mentioned the filings out there. I don't know how much you can talk about those filings, but again, we have 3 TruSector ETFs on the market. Is it just a matter of, as we see some of those other sector compositions potentially change, where maybe there are some larger companies and the indexes become more distorted, that would be the opportune time to roll out some additional TruSector ETFs?
I mean, that's one factor we're looking at, but I don't think having this diversification and over concentration issue is going to preclude us from considering bringing the rest of all of the 11 sectors to market. We're kind of doing it, fund by fund. Market conditions, client feedback is important to us, obviously. I think we would really love to have the full suite out there for investors to use, even if in a particular smaller sector like real estate, for example, that problem doesn't exist. But I don't think that's going to keep us from considering bringing that fund to market to offer investors a full VanEck solution to their problem. So obviously in sectors where the problem doesn't exist, that portfolio would just consist of stocks. It would not consist of a non-VanEck ETF holding.
Well, Michael, again, I find these very interesting. I thought you did an excellent job of walking through this TruSector ETF lineup. Really enjoyed the conversation. Thank you for joining me.
Yeah, thanks, Nate. Appreciate it.
That was Michael Cohick, Director of Product Management at VanEck.
Looking for ETF options from one of the top asset managers in the industry? Visit i.fidelity.com/ETFs to explore Fidelity's lineup and more. Fidelity Distributors Company, LLC, 500 Salem Street, Smithfield, Rhode Island, 02917. Fidelity Investments is an independent company unaffiliated with VettaFi and other third parties on this podcast. There's no form of legal partnership, agency affiliation, or similar relationship between VettaFi, Fidelity Investments, and other third parties on this podcast, nor is such a relationship created or implied by the information herein. Fidelity Investments and/or Fidelity refers collectively to FMR LLC, a U.S. company, and its subsidiaries, including but not limited to Fidelity Management and Research Company LLC, FMR.
I'm now joined by Matt Camuso, head of ETF Solutions at Baron Capital, who back in December, they entered the ETF space with a launch of 5 actively managed ETFs. And already they're up to about $550 million in assets. It's been a very successful ETF debut. Now, of course, Baron Capital we're talking about a firm that's been around since the early 1980s, very well known for their growth equity investment solutions, nearly $50 billion in assets under management overall. But they are now in the ETF space, and Matt is joining me from New York. Matt, welcome to the podcast. Great to see you.
Nate, thanks for having me. It's great to be with you.
All right. So as I just mentioned, Baron Capital, very well-known growth equity firm, been around for nearly 45 years, but just recently entered the ETF space. So I'd love to have you take us behind that decision. Why now?
Sure. So really, the decision overall was twofold. The first was actually in response to existing client feedback. So everything we do here at Baron Capital is client first focused, and we did hear from certain client types that while they really appreciated everything we were bringing from an investment philosophy perspective and overall outcomes, they just really wanted to see us in a different wrapper, mainly because of tax efficiency. And I think you and I have seen that across the industry. That's rise of active ETFs. Lots of benefits, but probably the number one, at least in our mind, is that more tax efficiency you get from the wrapper. So response to client feedback was first. As we started to look at, what the opportunity set looked like, the second was much more opportunistic. And we just mentioned with this rise of active ETFs, we've seen this more historical ETF user continue to adopt active ETFs. So this historical asset allocator using ETFs from implementation, now using active ETFs, we looked as a great opportunity to now bring those clients to Baron Capital. So as before they wouldn't have an access point, now with our active ETF lineup, they do. We're very excited for the opportunity and thrilled with the feedback we've seen thus far to bring those net new clients into our firm.
And we'll obviously get into the ETF lineup itself, but for people unfamiliar, Matt, talk more about Baron Capital's history and the high-level investment philosophy of the firm.
Sure. So yes, as you mentioned, I think at the start, Baron Capital was founded in 1982 by Ron Baron under a single investment philosophy that still exists today. It is long term, if you will, long only growth investing through a bottoms up, fundamental, research driven approach. Really, to put simply, what we look for is businesses with a durable competitive advantage that are really run by exceptional management teams. It is quite that simple. But I think what comes out of that, and really the differentiator that I've noticed since having the opportunity to join Baron Capital a couple months ago to help support this ETF business, two differentiators was that consistency in the approach. So that same fundamental investment philosophy that Ron started back in 1982 that exists today has really curated a culture across the firm, but especially with the investors, that's really unique. And I think clients appreciate that. The second, I think, is how we look at the world. Now, especially for a growth investor, we're much more longer term in nature. We like to say we don't trade stocks, we own businesses. So our typical holding period for any investment is 4 to 5 years, just as a starting point. Most can be much longer than that. So historically, our turnover is much lower than other growth managers, but it comes from that philosophy is we're not trying to tactically time markets or trade different stocks in and out. We really take a stakeholder type approach within a business, engage that management team, build that level of trust, see what that company can be in that 4 to 5 year period, and are there for the long term.
All right. So in terms of the ETF lineup, as I mentioned, Baron initially rolled out these 5 ETFs. And actually, let me run through these real quick. So there's the Baron First Principles ETF, ticker RONB, great ticker symbol. The Baron Global Durable Advantage ETF, ticker BCGD. The Baron SMID, small and mid cap ETF, ticker BCSM. The Baron Financials ETF, ticker BCFN. And then the Baron Technology ETF, ticker BCTK. Why don't we dive into what is currently Baron's most popular ETF? I don't know if you'd consider this the flagship ETF, RONB, which I mentioned.
I think by naming convention, you have to.
Yeah. Feels like it. Do you want to take us through this one?
Sure. Yeah, I think actually to start, and I appreciate going through each of the 5. Going back to kind of our decision to launch into the ETF space, something that was critically important to us was that we could bring Baron Capital for what everyone knows us for to the ETF wrapper. And so those 5 you just mentioned are 2 are conversions, the financial and technology ETF, so mutual fund ETF conversion, and the others are an extension of something we're already doing. So that was very important that if we're going to do ETFs, you're going to get Baron Capital as you have in other wrappers, specifically mutual funds and the ETF itself. RONB, or our First Principles ETF specifically, is an extension of our focused growth strategy and our Baron Partners strategy. So focused growth, more of a mid cap portfolio, partners, more of a large cap, best ideas, kind of high conviction portfolio. Bring those two together and the management teams, you get RONB. So RONB is managed by Ron Baron, David Baron, and Michael Baron, and is designed to be an all cap, more balanced growth solution. Again, combining that focused growth mentality as well as partners. From a naming convention, I love the term first principles, as I think it really embodies the mindset that underpins the investment philosophy we mentioned earlier. First principles thinking to us is deconstructing a business into its most essential elements, so culture, people, and strategy. And when you take a company apart piece by piece, you can get a true understanding of what makes that business really work. And then when you go to rebuild it, you can see from that lens what that company can be into the future. And I think speaks to the rigorous due diligence we do before making an initial allocation to any company. And again, that process that really differentiates us. In terms of overall exposures or what companies you'd find within First Principles itself, I think some are intuitive for a growth strategy. It's names like Tesla or Shopify, but also others that I think aren't so intuitive to some investors. We have some financials exposure with an allocation to MSCI, as an example. We have real estate or a real asset type exposure with a few hotel chains, if you will, but Red Rock Resorts is one of those. So I think highlighting the kind of different mix of companies that you see in the specific industries they're in really speaks to that more balanced approach. Across the firm, historically, we've always been overweight to financials, especially as I think most would assume from a growth manager standpoint, but that's intentional. We like the protection of financials exposure can add, especially in certain macro economic environments that might not be so supportive of growth. But it's the combination through all that due diligence, finding those exceptional companies that we really think have that long-term growth potential, but then pairing those from a name correlation basis, if you will, to bring a more balanced growth exposure relative to some other strategies you might have that are much more focused on that disruptive growth.
You mentioned a couple of the holdings in Ron B. There's one that you didn't mention that I have to ask you about, and that's SpaceX, which I'm sure you're aware this has garnered a lot of attention. Obviously, SpaceX is privately held. And so I have to ask you the standard ETF due diligence questions just around how you are handling this from a liquidity and valuation standpoint, because I do think those are the two biggest points of consideration just around private equity and ETFs in general. So how is Baron handling this SpaceX position?
Oh, you don't say. This is the first time I'm hearing we own that. No, honestly, we've been thrilled, especially as a newer ETF entrant, just the amount of coverage we've gotten off this. I want to make a couple, I think, really important points that have not been covered so much. The first is how SpaceX got into the portfolio. Again, everything we do is through this bottoms up, rigorous, fundamental, research driven due diligence, trying to identify these exceptional growth companies. Clearly, SpaceX is one of those. But what I don't want, the assumption to be is that we're just looking to put a private exposure for the first time in an ETF. This is very intentional, of course, and we've been investors in SpaceX for a very long time and hold it in other wrappers. The second thing I think is really important to hit on is how we own it. So we do own the shares directly. So we are on the cap table, which does differ from some other products, and I think is a really important distinction. How it makes its way into an ETF goes back to, again, that inception and decision to launch our ETF lineup. When building Ron B, again, from a kind of partners and focused growth exposure, SpaceX being part of the allocation, it wasn't obvious to us to just put this into the ETF wrapper. However, because we've owned the company since 2017, because we have a really unique relationship with the company over time, and actually because of ownership in other vehicles, we got a little bit more comfortable with its liquidity profile. Now, this is not to say that every single private company goes through this same process, but SpaceX specifically, we've deemed from our liquidity and risk committee to take that from an illiquid exposure to a less liquid exposure. And it's because of, again, the very unique nature of SpaceX, the demand we've seen from previous tender offers and how oversubscribed those were. Because of that kind of unique liquidity profile and our deeming of less liquid, we got comfortable with putting it into an ETF. From there, actually quite simple in terms of how it operates in an ETF. It's cash in lieu of securities at the last known price. So operationally, actually, I think works a little bit more intuitively than some would expect. But what I want to again make very clear, this is not Baron Capital saying every private company should be in an ETF. This is a very unique example, and it truly is not like we have another one waiting in the wings once we get a public offering here. If it comes and we get comfortable, just like we did with SpaceX, I think we've exuded the innovation and ability to do so. But again, a very unique situation here with this specific company. The last thing I would mention, I think it's just really important to bring it back to the strategy level. Again, as I mentioned before, it's this balanced growth approach. It's complementing different types of names, including SpaceX, with others that either might not be so intuitive as a growth exposure or have correlation benefits. I'd point out IDEX Laboratories. They do pet diagnostics for veterinarians. Right now, if you ever owned a pet, we're a dog family. Dogs become part of the family pretty quickly. You want to do everything to prolong their life, right? We look at the numbers right now, 25% or so of vet visits are leading to lab results. We think that number can grow to 50% pretty quickly. Again, with this kind of notion that pets do become part of the family, and IDEX is very well positioned to scale its business even further and capitalize on that increase in market share. So I just point that out again to make the point that SpaceX is great, and we're extremely bullish on that company. Of course, if you've ever heard Ron speak, but it's really about the strategy level and how all these different companies actually come together to deliver that more balanced approach.
I think several excellent points there, Matt. I love your first point just in that SpaceX fits under this concept of first principles, which you described before, that you're not putting this in the portfolio just to garner the attention that it has. This is something that is part of the investment philosophy, the investment approach of Baron Capital. I think that's important. Going back to your comments just around illiquid versus less liquid, and we don't have to get into the weeds here, but essentially, the way that I would describe this is the SEC does allow funds to own up to 15% in illiquid assets. That's not really even a consideration here if you go over that 15% because you're deeming this as less liquid. And so it wouldn't fit that criteria. Is that correct? And can you just elaborate on that a little bit?
That is correct. And one of the big considerations is, can you sell I think it's called a RATS portion, so like a reasonable portion of the investment within a 7-day period. Goes back to, again, our very unique and long-term relationship with not only SpaceX, but Elon himself. Allowed us to engage with the company and get really comfortable around this. This was not something that we just read the rules and thought that, made sense to us, let's do. We stress tested it. We do have a very robust process around this. But through engagement with SpaceX, we got comfortable that we could sell that reasonable size within a 7-day settlement period and not move the price, which then allowed us to move this to less liquid. Just to be clear, the SEC, I don't think approves or disapproves this, but we do, again, through our process and relationship, have the ability to get more comfortable with the liquidity profile. But again, on this very specific and very unique example with a SpaceX, and this is not for us, broad strokes across all private companies, even that we might still consider today.
Well, this will be a fun company to watch, especially if and when we get that IPO that everybody is anticipating. If we look at the rest of the ETF lineup, you did a nice job of just highlighting at a high level the various ETFs. But is there another one you want to spotlight? I mean, I'll suggest the Baron Technology ETF, again, ticker BCTK, but I'm open. Is there another one you'd like to look at a little bit deeper?
I would be happy to chat on tech. You made it easy for me because the old, cliche, you can't pick your favorite child, because I do love all of these. Technology has been coming up a lot, though, in conversations, and I think pretty naturally, right? We're still dealing with this, concentration risk, especially for these passive exposures, but we still have this AI craze and technology really driving, opportunity in markets. A couple things that I think make BCTK really, really exceptional. The first would be the management team behind it. So Asha Mehra and Michael Lippert, two co-portfolio managers, some brilliant minds, especially in the world of technology. So I think you'd be hard pressed to find a better duo than the two of them. Mike Lippert, just for that kind of relaying to other strategies that we run, is the manager on our Baron Opportunity Fund. That just won Morningstar's best performing fund in the past 25 years. So really experienced management team behind BCTK is the first point point I would make. The second, and this speaks to, I think, implementation of active ETFs. We've been seeing over the years a lot of this kind of core passive satellite with active. And I think BCTK brings a great opportunity for this for really two reasons. One, if you're just looking at a typical NASDAQ 100 type exposure, BCTK is going to add a nice cap diversification. So bringing in a more mid and small cap. So think of it, it's not just the technology companies of today, it's these innovators of tomorrow that we're trying to capture within the portfolio, but also adds that nice diversification to a passive exposure. The second is we do base it off a global index. So we do have the ability to add some international names in the portfolio. Roughly 20% of the portfolio is ex-US. Again, nice diversification opportunity relative to just a passive core for a technology exposure. And that's what we're hearing from clients is a great opportunity to get that alpha. If you look at a 3-year as of the end of February of this year, you're looking at roughly 600 basis points over a NASDAQ 100 type exposure. So coming through in fruition, we're actually seeing it coming through, as I mentioned earlier, with these historical ETF users looking to use BCTK as that satellite position to a passive core.
Matt, if we broaden out our conversation a little bit here, you had mentioned earlier just the growing popularity of active ETFs overall. And I think certainly a lot of listeners of this podcast, they know the story. Clearly, you know the story that active ETFs, they have been all the rage over the past several years. We've seen outsized inflows, tons of new launches. And I would say active ETFs have really just occupied the general mind share of investors. These are garnering a lot of attention, just like SpaceX. How does Baron like to paint the case for active management? Because I know you yourself have been involved with ETFs for quite a while now. And I'm sure you remember when passive ETFs were pretty much all the rage. That's all that investors associated ETFs with. But that's clearly changed. Now, investors are still putting money to work in passive products, but clearly active ETFs continue to grow in prominence and popularity. So I'd love to hear from you why you think that is and what you see as the value of active management.
Yeah, it is funny, Nate, after all the years, we're finally at the point that we don't walk into client conversations and people say, I use ETFs, I'm only passive, or I only use mutual funds, I'm active, right? We're now synonymous. It's just a wrapper conversation. So, oh, how far we've come. I think what's really interesting, especially if you look at the past year and a half or so, of the 1,100 plus active ETFs that come to market, these are very different things, right? We have our single stock trading vehicles, we have the buffered and levered products, you have your more systematic active. And then we like to say you have Baron Capital. So I think last week's show you had a great segment around the rise of systematic investing. And to make no comment on pros and cons there, I actually think that systematic implementation works, especially in the value bucket. But where Baron differs is, I think systematic people favor that it takes out human bias and human emotion. Where we would differ, especially for a growth solution, is what about human intuition? What about human interaction? Right. And we, as I mentioned earlier, we spend a lot of time engaging with companies before we make an investment and during the life cycle of that investment to make sure our thesis is the same. And I think it takes that intuition. It speaks to, again, the culture that Ron has built internally from all of his best practices now going across our investors, that ability to really understand where a company is today, but the intuition to see where it's going to go tomorrow. So I think we was coined, I forget who it was, but a segment a few weeks ago is the old school active. We love that. Right? That is who we are. That investment philosophy, again, for 40 plus years has stayed the same. That's where we differ. And I think, we're seeing a lot of new things come out as quote unquote active from, the audience perspective. I would just encourage you, stick to what you know and stick to what has always worked for you and not chasing new trends. I think once you do that and you can get away from these miscellaneous and non-traditional and different sorts of active, because the shell shock of looking how much product has come to market is real. I look at it every day and I still am put back in my seat a little bit of how much is coming out. But if you've just used that traditional active like we offer, right, that universe can get a lot slimmer and a lot easier for due diligence. I think everything I just said in summary, it's great for the industry. It really is, right? We're adding choice. As I mentioned, we're bringing Baron for the first time to historical ETF users. Takes a lot of due diligence, but I think it's all for good reason. And that tax efficiency of the ETF wrapper now coming through to the active side for the end investor, I think it's all positives.
Let me ask you this. I think you mentioned ETF due diligence. You started down that path. It's one of my favorite topics. So I'm gonna keep trotting down that same path here. Um, let's assume you're right. There's many different flavors of active ETFs out there, and I think that's clearly very important for investors to understand that everything that just has an active label on it, they're not all the same. Let's just stay in the pool of traditional active management, or what you said, old school stock picking. And I'll ask you, I'll frame it like this. Baron Capital obviously has an excellent long-term performance track record. Anybody can go check that out. Does it simply come down to that when investors and advisors are evaluating traditional active ETFs, or should there be other considerations when filtering through the growing number of options here? Because even in that old school, active space, there are continuing we're seeing a lot of growth there, and I think we're going to see more as this ETF share class structure rolls out. So, as the active universe expands here, are there other considerations, or does it come down to performance? Performance is king.
For active, we would be remiss if we didn't say performance is very important. I don't know how much time we have, but I could talk about this for a long time, as you mentioned, probably as could you. A couple things I would point out. Just because an ETF is brand new to the market, this is for the audience. Don't assume it's brand new to the firm, right? As I mentioned, we had two mutual fund to ETF conversions with financials and technology, and then our other products are extensions of things we've done really well for a long time. Where I'm going with this, Nate, is if you're interested, engage with the ETF issuer. You will probably find a track record that might not be the same thing, but it's up to you to deem, is it close enough to get you comfortable to start your due diligence if you need a 3 or 5 year or whatever your criteria might be. I think too often we're seeing, oh, that's brand new. It launched in February. I need time. Well, you might, but again, engage with the issuer. I guarantee they would love to talk to you and ask them if there's anything related that you might be able to perform due diligence to get to that performance, but also style and fit. We always say to clients, we understand we're probably not the only thing coming into your portfolio, or that cash is just waiting to be allocated. Use the benefit of ETFs and that daily transparency to work with, again, the issuer. We offer these services. Here's my model. Here's the product I'm looking at, right? How does this fit with what I currently own? To again enhance your due diligence. And the last thing I would just caution, right? Always remember what the T in ETF stands for, which is traded. With the more product coming to market, I think the ever more important that you have a dedicated capital markets desk at the ETF issuer that knows exactly how to support these products from a liquidity standpoint, and also engage with those folks. Really understand what is the basket liquidity, right? What is that implied liquidity of the ETF? What are some trading best practices that the issuer would consider just to make sure that you have a good experience? With all the more product coming to market, there's only so much capital out there that can be committed to these products from a liquidity standpoint. You really want to make sure that issuer is taking this part of the business very seriously. Here at Baron Capital, we have myself and Brian Moore, our head of ETF capital markets, very experienced in the ETF industry. And I just think, again, all the more important with this much product and probably a lot more coming on the horizon from a due diligence standpoint, you have some sort of check the box criteria within your due diligence line items that looks at liquidity, that makes a relationship with the ETF capital markets desk, and really gets comfortable with what execution should look like.
I love those words of wisdom. I can tell you, and again, this won't surprise you, just from my years of being in the ETF space, I found that advisors in particular, for whatever reason, some are reluctant to engage with ETF issuers, and ETF issuers want to help you. And you hit on something like ETF capital markets, understanding how the products trade, but even just more broadly understanding the investment strategies. And I'll add, obviously in the active space, performance is very important, but if you can understand that investment strategy and how it reacts in different market environments, one of the things I always say is the best ETF or the best portfolio is the one that you can stick to. And so if there's some variation in maybe your expectations versus how an ETF performs, you may not be able to stick with it over a long term. But I think if you understand the strategy, you understand how the managers are operating, clearly that's going to help you stay more comfortable with the strategy through thick and thin. And I think in active ETFs in particular, that's very important, especially if you have active ETFs that aren't just, closet indexers, where you are going to have a little bit more tracking error. I don't know if anything you want to add to those comments.
No, it's so well said. The only thing I would add is, mentioned a few times, for us, what's really important is setting that expectation, as you just mentioned. The biggest expectation for us is you need to understand our investment philosophy, especially how we look at investing, right? We are long-term investors, and we really want clients to understand that before ever using us, because that should help set expectations, especially in maybe periods of market stress. But then we can engage with the client and say, well, here are the reasons why, but goes back to that robust due diligence process where we're saying we're engaging back with the management team of the company. We're retesting our hypothesis. That will be ongoing, but if you're setting that expectation of what your investment philosophy aims to do and the time horizon around that, I think you're off to a really good start.
Matt, before I let you go, I have to ask you, might we see additional ETFs from Baron Capital moving forward? And I'm not expecting you to give us your full playbook here, but maybe how are you thinking about future product development?
I am thrilled to tell you, yes, you will see more from us. We've already gone effective with an EM Select ETF, which should be hopefully launching in the coming months here. And we've just filed for another ETF, which is a risk optimized large cap growth, still in the quiet period. So can't say much on that one, but two more in the hopper. And what I love about this firm is, when they go into something, they go in with both feet, and we're kind of going across our lineup, engaging with clients. What would you like to see from us next? So, this is certainly the start. We're thrilled with the receptivity. We're so appreciative of the clients that have already engaged with us through the ETF platform, and very excited for what the future holds.
Well, Matt, again, great having you on the podcast. Congratulations on the launch of this lineup and the initial success that you're having. Certainly wish you the best of luck moving forward. Thank you for joining me.
Thanks so much for having me, Nate. Good to see you.
That was Matt Camuso, head of ETF Solutions at Baron Capital. That'll do it for this week's ETF Prime. Build your ETF expertise and separate yourself from your peers by registering for the ETF Institute Certified ETF Advisor Program. You can learn more at cetf.org. Next week, I'll be joined by Simeon Hyman, Global Investment Strategist at ProShares. So we're going to discuss the recently launched Genius Money Market ETF, which, get this thing is already over $22 billion in assets in just over a month. So we'll talk about what's driving that and how this ETF is being used. Until then, have a great week, everyone.
ETF Prime is hosted by Nate Geraci, president of OTR Media, LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with VettaFi or any of its affiliates. VettaFi's participation in this program should not be construed as an endorsement or an indication by VettaFi of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.